Okay, what's going on, people? Accounting system part 4, here we go. Um, it's been going really, really good. Yesterday we got through all kinds of stuff. We got through the OPEX, depreciation expense, capital asset purchases, all of this. Today we're going to get through taxes, unearned revenue, and who knows what else I'll have to see. Before I get started, don't forget to check out smarthelping.com. The accounting bundle is where the sheet will be when it's finished. Note any bundle purchase on the site gets you lifetime access to everything in it that ever gets added to it as well. Just ask for a refresh. And you can buy everything on the site for $9.99. There's hundreds of different templates and tools here built in Excel, um, Google Sheets, all kinds of things. Now, let's get our links out to Twitter and get to going here. Get to going here. Get to going here. Sounds good. I don't know what's going on with my computer, but the screen has been flashing intermittently. On my side, you guys can't see it, but it's going black. So hopefully that's not a problem today. Okay, so first things first, let's do taxes, because if we do taxes, this thing is essentially usable at that point. At a, you'll be able to do revenue, cost of goods sold, OPEX, depreciation, and taxes. So those are like the main, if you're going to try to use it, those are all the things that you almost have to have. And then we're going to start adding new, not so common things, but still things that are going to be important to have if we're going to have a complete accounting system. So taxes, a couple things. Let's think about it. So tax expense is going to hit the income statement. We are going to have to differentiate between, and this is income tax we're talking about, not sales tax or anything else. So income tax expense. What are our entries here? Let's look. Journal entries for income tax. Yep, that's what I thought. So you're gonna apply it when it's accrued, and then you just debit the payable or credit the payable, and then when it's paid, you debit the payable, credit cash. Yep, deferred tax liability. Okay, so that's fine. So we'll do income tax expense will be the entry, and then that automatically increases the payable. And then we have the other entry would be payment of income tax. So let's put it in here. Let's say in January, we accrue some income taxes. Let's just say 500. Let's do a couple months worth just so we can see it flowing through the table a little bit. Oh, see, my screen just went black again. Okay, that's going to be really frustrating if that keeps happening. So you got Jan, Feb, March, income tax accrual, whatever it might be. And then you've got, let's say in March you're going to pay these. You would do payment of income tax. Let's say it's 1400. Now the question is, if you're paid, if you're accruing here and then you're paying, what if the accrual, well, I guess the adjustment happens at the end of the year. That's different. So 1400. Yeah, I think this is good enough to get us to a point where we can just say, okay, here's your expected, or your income taxes you're accruing. Holy cow, my screen keeps going black. That's really frustrating. What is wrong with my cords here? Something's wrong. Let's try to plug these in better or something. Uh, yeah, that's really annoying. Okay, let's go back here. Journal entries for paying income tax. Let's just see what we got here. No, this is the same sheet. So if you have an income tax refund, we also need to look at that. Okay, so you simply reduce income tax on the date you get the refund and increase cash. Okay, so that is fine. The issue is in this system, we okay, yes. So what you would have to do if there was an income tax, if this was a credit, you just put a negative number here. So then when it flows through, it actually reduces this, which is going to be subtracted anyway, so technically it would add it back. So that's fine. So this two entry system would work. So you got income tax expense, payment of income tax. If there's a refund, you just put a negative. And I'm going to make notes on all the accounts so it's easy to see, or for what's actually supposed to happen. Oh, wait a second. Yeah, this is the original entry. Sorry, crediting cash reduces cash. This is the adjusting entry, so you increase that and you credit income tax expense, reducing it. Okay. Now, what if you know you're getting a refund but you have not received it yet? Now this is getting really down into, I don't know if we need to get as far down as income tax receivable and income tax payable. Let me see here. So our first entry is going to be, this is just our regular entry. The payable, the income tax payable is automatically going to populate when we enter an expense, and then that will get reduced whenever we actually pay. So this is an automatic. You're not going to have to actually enter this. Income tax receivable. Okay. Well, let me get back over here. So this is fine. Now, if you just have income tax expense and you pay it right away, you'll just put in income tax expense in the same month, put the amount, and then put the payment for it in the same month as well. So let's code this in with formulas. So we have, where's income taxes? Here, we simply sum ifs, and I don't want to rewrite this all the way out. We've already got it here. Taxes, and we're summing up anything that says income tax, I believe, income tax expense. Drag this over. So there's the expense. Now on our balance sheet, it's simply a current liability. Because it's less than 1 year, no border. And we put in income taxes payable. Now the payable is going to be simply taking all of anything labeled income tax expense and adding it, and then reducing anything that says payment for income tax. Pretty simple. So we go 5. Oh wait, we got to add the previous period as well. And this is going to be out for 20 years when I'm done, but right now I'm just building the logic. Payment, what's this called? Payment of income tax. Okay, and add this at the end. Perfect. So we go 5, 12, and then we pay it all off in March at the end of March. So that's good. We also, cash flow is just going to, well, let's see. So cash flow, this is not, well, no, this is operating. So let's add a couple more rows here. And we have, oh, this is annoying. My screen's literally going out every other second. I can't see anything. This is so annoying. We have add back income taxes. Oh, this is bad. What is wrong with my monitor? Move this over. Maybe that'll help with the chords. Add back income taxes. Accrued. Reduce payments. Okay, so we go there. And so add back income taxes accrued is just anything that says income tax expense. That'd be a positive because we're accruing the expense, but we're not actually paying it out yet. And then we reduce when it's paid. Payment of income tax. And then when you sum this all up, it should zero out because the net income is seeing the expense, but we don't actually have the expense coming out yet. So it zeroes out, and then there we actually pay it. There's some accrued here, but that's also getting accrued and paid here. So this is the effect of that. Now we are off on the balance sheet. Let's see. Probably because we haven't added this in. There we go. Okay, so that's fine. What else are we missing? So there's when the actual cash drops. So this goes down, that's fine. Now the question is retained earnings is getting hit. And then, oh yeah, we're matched up. So check here to 0. So that's perfect. Okay, so we have, and then let's say, you do this again in April, May, June, and you accrue the same taxes, and then you pay them off. So you can see here, here's how the income tax hits the income statement. Balance sheet, it's going up, up, paid off, up, up, paid off, and cash flow statement. So there's the actual expense. Here's the add back of the accrual, the actual payment coming out there. So it's pretty simple. Now again, if there is a refund, you simply hit a net. You'll hit income tax expense as a negative, and then you would do payment of income tax as a negative. So if these were, let's clear this out. If this was a refund, let's say there were only 2 entries here, and you want to record a refund, it'd be negative 500 and negative 500. And in that case, you go to the income statement. It reduces your expenses, so it'd actually be an increase in net income. Balance sheet sees this as a negative, negative, and then it's because this would be a credit, or almost, this would be technically a receivable. Well, in theory, this would happen on the same month, so you wouldn't have it. It'd just be on the same month. You would have it, yeah, so that there's no effect here. And the cash flow, you actually have a positive 500, and then this zeroes out, and you still have the 500 cash. So there's the credit income tax refund hitting. So that works. And then if you have, the only thing that's not here is if you have an expected refund and you find out you're owed money, like in 5 months, so that's where you could do it like this, and it's like a contra payable, but technically that's just a receivable. Um, but I don't know how relevant it's going to be to put in expected receivables for tax refunds. That's like so obscure, and it's just rare that you would end up putting that in because you really often don't know. But maybe if I have enough requests for that to be added, I will add it. All right, so awesome. Here we have expense, income tax expense, all coded in. Looks all good. The next thing we need to do is deferred revenue. And I'm actually going to drag this up here. So let's copy this down 3. I think we'll need 3 accounts, I believe. So what's deferred revenue? Well, it means, let's say you're a SaaS company or contract company and you collected all the cash up front, but you're providing the services over, say, 7 months. So you would have to include it's actually a liability, which would be unearned revenue. But how you trigger this is you would say, let's see, the entry would be deferred revenue. And that wouldn't actually count as revenue on the income statement, only when it gets recognized. So we want to put deferred is going to increase the liability. Um, what's the other entry we want to have the user input? Let's think about this. So the actual entry we want to enter is, so let's say, okay, the first thing that happens, you collect the money. So on some date, collect money for contract that you're going to provide services for. So let's say you collected $2 million. What do you know? There's zero in there. So I collected $2 million. I now have to provide $2 million worth of services over time, but I have the cash. So we could say 2 million in deferred revenue. So that will, I can target that with the formula, increase the liability. And then when we actually recognize the revenue, let's say you recognize 1/8 of it in January, we say recognized revenue. Now we put, so this is the next account we need. We could put recognized, or how do we want, yeah, I guess recognized revenue is the best account. So deferred revenue creates a liability, recognized revenue reduces it off. Let's put this in here, just walk through the logic. Let's say you recognize, what did I say, 1/8 of 2 million. So you got 250,000 of it happening in, and let's actually say you collect, or you actually provide the services in the following month, so February. And then again, in March, same amount, 250,000. And this is, we can just do this in every month if we wanted, until it's fully recognized. Now what this tells people is, hey, I have to provide services. I got the cash for it, but I haven't provided the services. So it's, investors might want to know that on an aggregate basis. Now on the income statement, what we have to say here is this is going to be sales, and I don't want to change the sales, any logic that's already here. So we're just going to say plus, and we're going to copy this. Anything that says recognized revenue. And then before I'm done, I'll make sure this is still working with all the existing logic. So there's the recognized revenue, looking good. On the balance sheet, we have a liability, and this one's going to be called unearned revenue. Let's format our line here. Now, unearned revenue will equal anything that says, what was our entry? What do we call this? Deferred revenue. All right, so we add this deferred revenue, and then we subtract, I believe I called it recognized revenue. Yep, okay. So balance sheet, we got 2 million. Now we've recognized some of it here. So we accrue that and add it over time, and then also add it here in the subtotal. So there's the account. It's a liability until it goes away. And here we see we actually didn't provide all the services yet, so there's still 250,000 remaining that hasn't been recognized. Now the cash flow statement is definitely going to be in here, and I'm just going to put it down here. We're going to put let's see, reduce recognized revenue, and we actually say increase here, add deferred revenue, because we actually collect the cash when it is entered as deferred. So reduce here, so we want to say subtract anything that says recognized revenue, because that actually wasn't cash coming in, even though the income statement is counting it as net income. So subtract that out, and then we actually put a cash increase if it is unearned revenue. Add this. Now, what did I call deferred revenue? Deferred. And that's a positive value. We've collected the cash here. And then it zeroes out. So the actual cash effect is okay. I got $2 million. I provided the services over time. So I recognize the revenues here, but they're not actually cash in. The cash already happened here. Okay, so this looks good. Balance sheet balances. That's good. Now let's make sure, so this works. Let's make sure we also have the functionality for regular revenue stuff. So let's say we have some sales here. I just want to make sure this logic didn't get broken at all. Let's say we had sales on account, and then let's put, what else do we have for the sales account? Receipt. Put that in March, and then we also have maybe some refunds, contra revenue. Okay, and let's look at this, make sure nothing worked. So 752, there's the contra, the refund, 250, 250. So these sales all were, okay, let's do one in March or Feb. So 5 and 250. And then we had 250 from the other one. Okay, so that makes sense. Balance sheet. Good, we're checked off there. Here's the receivables on that 250 sold on account. Then it gets paid back, so go to 0. Unearned revenue still's working. Cash flow statement. Less sales on account. Add back receipt from sales. Okay, I think this is good. Sales. Cool. Okay. So we've added taxes, unearned and unearned revenue as options to enter. Everything seems to be working great. Now the question is, what else do we need here? And now we're going to get into the more of the nitty gritty, like We'll have to have, what if you make, what if you're paying interest, and what if you take out a loan? So we'll have to do that. So let's do, so if you take out a loan, you're going to increase cash by whatever the loan amount is. So let's say I borrow money. I now, let's see, what is the entry going to be? Loan, what do we want to call this? I guess loan proceeds is the best term. So loan proceeds will increase cash, increase the liability. Now when we pay that back, we'll have um, principal payments on loan, interest expense. Those are our two items. So that those three things should track. Let's code it in. So here, it's only going to hit the income statement in regards to the interest expense. So let's put that in. And I believe I just called it, yeah, interest expense, so that's fine. Now, the question is, do we need to also do a third entry saying income, interest expense, interest payable, and then payment of interest? I guess probably, because when you get the bill, the invoice to pay, you enter it, and then when you pay it, you go. So yeah, we're gonna have to do that. So we also need to put in, well, interest expense automatically flows there, and then we'll have to add another entry called um, payment of interest. We can put payment of interest expense. Okay. So here it's still just interest expense on this row. We have the loan, which is going to be, we're going to assume this is a long-term liability. So in that case, we just need a regular sum if. And what we want to do is sum up anything that says loan proceeds. And then we're going to subtract out anything that says payment, principal payment. Let's see, how did I label this? Principal payment on loan. Principal payment. Okay, and so that should be all the logic we need to account for what the balance of the loan is over time. All right, so we got interest expense, we have the loan going up and then being paid back with this. Oh, interest payable. So this is a short-term liability. So another liability here to put in, and let's call this interest payable. And really all these roll up into accounts payable, but I'm separating them out just to be, I think it's better if we're going to show it I think we need to show each one instead of trying to roll all these formulas into one row. It'll be too cluttered, so I'm just separating it out, and I think that's fine anyway. Um, okay, so interest payable would be any interest expense less payment of interest expense. So interest expense increases the liability, and then subtract out payment of interest expense. Then we're going to go through and make sure all this works in a second. Put our bottom border back. Okay, so, oh wait, we got to do cash flow. So this is now we're moving into financing activities. Let me just get the formatting on this. So uh, we'll have loan proceeds as a cash inflow. We'll have add back interest expense. And reduce interest payments. Also, principal payments. And I believe that's everything. So let's add this in. So add up anything that says, let's see, what do I call this? Loan proceeds. So any money coming in from that, then we want to, oh wait, that's going to be positive value. We also want to reduce anything. No, we want to increase anything that's interest expense. Because that didn't actually come out of cash. It does whenever we actually pay it. And then so we'll decrease cash on payment of interest expense. We will also reduce any, what do I call this, principal payment on loan. Alrighty, so let's see if this works. Let's start. Now the biggest issue is probably going to be my spelling, but we'll see. So let's say on February, I took out a loan. So we go loan proceeds. Let's say we did a $1 million loan. And then in February, I have interest. Interest expense. I get an invoice for interest expense, let's say for $2,000. It'll be for principal and interest, but this is the interest portion. Um, and on the same month, I also pay it. 2,000. Also, we have principal payment. Let's say that was, 400. And I believe that should be, is that everything? Payment of interest on its principal. Yeah. Okay, so that's the accounting transactions. So let's see if it worked. All right, so interest expense is an expense on the income statement, reduces that for 2000. That makes sense. Balance sheet, we have cash coming in from the loan. Here's that. Retained earnings gets hit with the interest expense. That's good. Loan payables going down by 400 when that payment hits, so that looks good. Cash flow statement, net income, cash here coming in, and here we're adding back this, reducing this, so net -2 minus the 400. You end up with 2400 because you've got interest actually being paid and principal. So that looks good, and we have balance sheet is balanced at the bottom. Perfect. Assets equal liabilities plus owner's equity. All right. Now let's say, what if we didn't pay this interest expense till March for whatever reason? If we go to the balance sheet, yeah, there we go. So now we have an actual interest payable balance. Here's the payment. Oh, wait. So here's an error. And I probably just didn't add the previous month yet. So this is why we do these checks. Because that should zero out. It doesn't need to go negative. Okay, yeah, and all these should have that. Let's just double check. Okay, perfect. Because look, if we undo, when that was negative, look at, we didn't balance there. So something was definitely off, which was that. All right, well, we're all set on that. What else can we do here? We've added taxes, loan, interest. We added deferred revenue. This thing is really coming together. Okay, so this is all good. Let's clear this out. So we've got other income, other expense. These would be non-operating items like, let's say, interest revenue. If you're not a bank, your interest revenue is not your main source of generating profits, but it is still an increase in income. Other expenses could be things that are just not your regular operating expenses, but it is an expense for whatever reason. Now these items, I don't I don't know if we need to put an account with them as well. Like, does it need to have a deferred income, deferred expense? I mean, I guess we could. We could just lump them all in those. So you'll have, let's see. So for other income, other income's just the entry that increases that value. Question is, do we want to put like other income on account? Because usually, if you have other income, it's not part of your normal operations. You probably don't even know you're getting it until you actually have it. So there's no reason to put it on account. Um, Same thing with other expense. So I believe it just hits one time in the income statement as an expense or income, and then cash flow, and it doesn't affect the balance sheet. So whenever it actually happens, you would just say, okay, you know, January, we have some item, let's say it's an insurance claim or something like that. You have other income of $5,000. So that's great. You now have this increase, so this would just be, where's the simple sum ifs here? you just have this as a positive value here. Anything that's labeled other income. Also an expense, other expenses. And this would be, we'll just put it as a negative there. And then on the cash flow statement, now this is tricky because it's not part of your normal operations. So does it go under financing or investing activities? Oh, and another thing we got to add is like receipt of cash from stock, like selling stock or equity influx. Let's see, because I'm actually quite curious here. What? Let's see. Journal entries for other income. Or wait, what was I looking at? No, I don't want the journal entries. Um, does other income? No, other income on cash flow statement. Operating activity. Okay. Right, so it's not regular business activity. Here we go. Other operating income includes more expense line items and gross profit. Operating income does not include items such as other income, non-operating income. Okay, so where do we put other income? This other income expense. Where does that go on the cash flow statement? Non-operating income is a portion of an organization's income that's derived from activities not related to its core business operations. It can include items such as dividend income, interest, gains or losses from investments, as well as those incurred in foreign exchange and asset write-downs. All right, where would I find a company's operating income? Cash flow statement. Activity. All right, I just want to see other income on a cash flow statement. Here we go. No, it doesn't say it on there. It's not detailed enough. Oh wait, is it in financing? Okay, where does other income sit? Let's see, like dividends receivable. All right, actually, let me just put that in. Well, no, that would probably be under financing. That's actually not that. But what about like an insurance claim? CapEx, right? Dividends paid. We'll have to do that as well. Let me make some notes here on this. So we want to do, remember, we also want to add disposal of fixed assets. We want to add dividend payments, which is under financing. investing activities. I'm assuming we're just gonna put it all under financing activities. I think that is the most logical place. So on here, we're just gonna put other income expense, and it's actually just going to be the amount of those items here. So this plus this. Oh, wait. Hold on. So it's actually already hitting that income. And since we're not doing these on account, we don't even need to have this in here at all. It's not even necessary. Because our cash flow statement's working off of net income, and these actually, since these are happening in the period, we're just saying that they hit. Um, okay, so that makes sense. So that's that. Okay, that's balance there. So we just have. Now, why is this reducing cash? Total other income expense. We want to add this in. C47 should be a plus. Okay. So there's the cash coming in. Net income. Yeah, we don't need to put it anywhere else. It's just hitting net income. Now let's put in the other entry just so we know it's working. So let's say in January we also have let's some other expense that's non-operating, but it should still hit the income statement. 5, 4. All right, so 1,000 there, 1,000 there. Okay, so that's kind of a catch-all because other income and other expenses could be all sorts of things, um, like insurance claims, for example, would be other income. Uh, Dividends received, interest, revenue, all of that stuff just hits in other income. Now we're not doing a triple entry on it, so there's no liability or expense or asset created on these. It's just happening in the period. And again, these are going to be uncommon things that don't happen a whole lot. But if they do, you can just put the month that happened in other income or expense, and it flows accordingly. Now, like I just mentioned, we need to add if the company is paying dividends. Also, if the company is disposing of fixed assets, so there's still a ton of stuff to do, and there's a lot of things like this. And I don't think dividend. Well, let's look at this here. Let's see. Journal entry for paying dividends. Let's just put for dividends. I'm assuming when you declare the dividend, that's when the liability hits, and then when you pay it, so it's probably just going to be standard, let's see, record $100 dividend payable. Yep, that's what I figured. So that's going to hit net income, I believe. Wait, dividend payable. Yeah, because it's. Oh, wait. No, it hits directly on retained earnings. So when we record the dividend, we reduce retained earnings by the dividend amount, increase the liability, and then when we pay it, dividend payable, we reduce that and then reduce cash. Okay, that's good. That makes sense. I'm just going to make a note here on this. So for dividend payments, reduce retained earnings, increase div payable, and then reduce div payable, reduce cash. Okay, that's fine. So similar. So I don't know if I want to add this yet. Today, so far, we've already done deferred revenue, income taxes, loan, principal payment, interest expense, and other income, other expense. So dividend payments, disposable fixed assets. So dividends don't actually hit the income statement at all. They're going to hit balance sheet and they're going to hit cash flow under financing activities. Now, when you receive dividends, that can be lumped in, that will hit the income statement as other income, not, and that will then flow to retained earnings in that way, but it's different a little bit. Okay, so that's fine. What else do we want to look up here? Let's see. What else do we want to do? Is 1056. And how much juice do I have left is the question. Uh, do we want to power through this? We could try to do, let's do the dividends real quick. Okay, so we've got declare dividend that affects retained earnings when it's declared in that month. It increases the liability, and then we want to say pay dividends is the second part of it. All right, so nothing's hitting the income statement. Balance sheet, we have another current liability. And this is going to be called dividends payable. And dividends payable is going to equal all declared dividends for the month less any dividends that were paid. So declare dividend, pay dividend. Reduce that S so it's easier. Declare dividend, pay dividend. All right. Now what I thought was interesting is it actually directly affects retained earnings. Declare dividend increases, pay dividend decreases. All right, and then add the previous period. Now what I'm going to do when I'm done with this model completely, or system, is we're going to actually run through every single transaction and build an entire example to make sure everything is balancing out and working. Make sure we add that down here. So that's that part of it. We also need to say any oh, I didn't spell that right. Declare. We also need to say any declared dividends reduce retained earnings. So we want to pull this. And we go to retained earnings. And actually it's going to be a subtraction of that. Okay, and then on the cash flow statement, so under financing, we're going to have well, let's think about this. Since it only hits retained earnings, first of all, what's this 1,000? Is this from the previous? Yeah, this. All right, remove these for now. We know that works. So it doesn't hit net income when we add the liability that zeroes out there. When we pay it, so uh, paid dividends would be that, and it simply equals anything that says pay dividend, and it's going to be a negative. So that's good. We pay dividends. Let's see. Now, does that well? Let's start doing the transaction. So let's say January 2023. Um, we declare the dividend. Let's say we declare dividend total is going to be 600,000. Okay, and then let's say we declared it for some other date in the future when we pay it, and there's when we pay the dividend for 600,000. Now let's check out our financial statements and see if we coded it right. So income statement's not affected. Balance sheet, we have a liability here. And actually, let's put this a couple months out so we can really see it. So we have our liability here, dividends payable. Retained earnings going down. Okay, and here we have an issue, so we'll have to figure out what's going on there. Cash flow statement, we paid it out here. Okay, this is fine. So we do have, and this is what I was wondering, is I felt like we were missing one side of this somehow. So in April, when this is paid, we no longer have a liability. So we reduce the payable. We also reduce cash. So this goes down, that matches. Now the question is, retained earnings is down. And we have this. So what am I missing here? We're missing one side of this somewhere. And I'm not sure. Let's look back here. So record $100 dividend payable. We debited equity, which is actually a reduction, so that we reduced that, so that was fine. We increased the payable, and then when we pay it, we debited the payable, so that goes down, and the asset goes down. Okay, that makes sense, and both of these match, so why are we out by the amount? Well, let's just look at one entry and see if this is, let's just put this at 0 for now. So if we put that for 0, that's fine. We have the dividend payable and we have retained earnings. All good. And that matches, that's basically this happening here, this first entry. Now the second entry, in theory, should reduce this to 0. So this goes down as a liability. And also cash should go down as asset. So both assets equal liability plus owner's equity. So this should balance out. But it's not, and I don't know why. So in theory, this is going to be negative. This goes to 0. What am I missing here? Because that would, yeah, it's going to be off because this is still negative. Oh, let's think. Got to think here. Why are we negative? That balances as it stands, and then this is gonna go down, and this is gonna go down. Well, you have dividend payable going up and down. You have retained earnings going down and cash going down. So these all should zero out. What am I missing? So we pay this here. Yeah. Wait, it checks out. I don't know why. Why did I think it didn't work? So there you have the 600,000 going out. Retained earnings is negative 600. This and we're checked out. Maybe I was looking at the wrong row. So the check row is good. So that's awesome. Okay. So, well, we added another option. So we have dividends now working. That was fun. Check this off the list. Logic for disposing of fixed assets is another one. So let's look at disposing fixed assets here. Um, so if I want to, let's clear this out. So this is all good and dandy. If I want to sell a fixed asset, what are we going to do with the journal entries? So let's look at journal entry, selling fixed assets or disposal. Okay. Yep, all sorts of fun stuff here. Uh, so depreciation expense. Let's assume the company sold a fixed asset for 20,000. We are debiting depreciation expense. Oh, this just updates. Okay, so we already have this. We already have depreciation logic built in, so that's fine. This already exists, but the disposal, we then say, so debiting cash, that's fine. That will be in cash flow statement under investing activities. So increasing cash. Now we're debiting a contra asset here, so accumulated depreciation gets reduced. We reduce the fixed asset, and then this would be an other income entry, gain on sale of fixed asset. Okay, so this is pretty easy. Let's do this. Where am I? So let's say in February 2023, sale of fixed asset. What are our accounts? So we actually have to define like what we want to call this, which is kind of interesting because we know what the entries are, but we have to define what's going to trigger those entries. So we're going to say you can call this sale of property, plant. This needs to be easy. Sale of capital assets. So when we sell the asset, that triggers all of the entries we just said. And you have to use other income as the other for the gain. If there's a gain, and then we'll do the loss, which I'm assuming the loss is going to be the same thing, but we just use other expense instead of loss. Um, okay, so sale capital assets. Let's say this happens here. We sell an asset, whatever it might be, for 25,000. Now, let's look back here. what's going to be hard is you have to figure out what was the total accumulated depreciation for that specific equipment piece, which is going to be a little bit difficult. You'll have to go, yeah, that I mean that's going to be hard. So you'll have to look at all of the entries, and in theory you should have been marking depreciation. So let's try and do the full entire like life cycle of an asset. Um, so here's the sale. This doesn't have to be in order on here. Let's say in January, and let's change the sale to some point in the future. Put November. So let's say in January we buy it. We buy something. So where's my capital asset account? So here it is, capital asset purchase. Let's say we buy something for 250,000. So we buy this capital asset, and then we say, okay, now what happens? Well, we have depreciation, and we also have the option to buy it on account and then pay that off over time. But that's uncommon, but it is possible. So capital asset purchase, I believe we just have that happening all in one transaction. Let me double check. Yeah, so that's just going there. Cash is going down. Perfect. Okay, so now we have depreciation. What's going on, Mayank? I don't really know how to pronounce your name. I'll just call you Sharma. Good to see you again. Uh, where's our depreciation expense? So here, let's say we record depreciation expense of whatever. Let's just say it's 1/7 years divided by 12 times the amount. So we have depreciation expense happening for a couple months here. So here's that. Right, and then we sell it in November. So Jan, Feb, all the way up to November. Moon, cool. Very cool. Um, all right, here's our expenses or depreciation expense on this capital asset, and then let's say we sell it for 25,000. Now what you'll have to do is put uh is there videos of models I built from scratch? Well, yes. There's a lot. Uh, you have to go look through, but look at anything basically that says live financial modeling. Usually that's what I do during this time, but I wanted to build an accounting system for this week. There's a lot. You'll have to go. I mean, there's like hundreds. You can go all the way back to, I think I started doing them live in January of 2020 or 2021. I can't even remember. But yeah, you'll see in the live videos, um, building everything from scratch. Okay, anyway, here we have our capital asset purchase. We have depreciation expense happening, and then we sell it here. And we also need to record, and actually, do we even have an option to debit accumulated depreciation? I don't think. So if we look at our balance sheet, here's this, here's our accumulated depreciation. We have no way to actually subtract this out or reduce accumulated depreciation. And there's no way to automatically know this. So what we have to do is add an entry here in the validation called, and we'll put it by the other depreciation item. And what I'll probably do when I'm all done with this is put these in alphabetical order, or I might try to put them in order that I don't know. I'll try to find the best way to organize these. uh, but where's depreciation here? Okay, let's move these down one. So we need a way to just arbitrarily increase or decrease accumulated depreciation. So there's that. So now on this entry, when we sell, we have to clear out all the accumulated depreciation for this specific item. So there's that. Let's add it up. And actually, we could just sum this up since there's some decimals. So there's that entry. Now, we have to right now define if that's going to reduce or increase the amount because it is a contra asset, so it's kind of confusing. So normally it's a negative asset balance. We want to reduce it. So to reduce it, we would add a positive value, and then if you actually wanted to, for some reason, increase it, but in theory, you should never need to increase this. This is just the total value of all the depreciation expense that's happened. So there really should never need to be an adjustment on that side of it. But on this side, we do. So it does need to be a positive value. We'll decrease that here. So let's add, where's our sum ifs? So we need to add a sum ifs. Here. And we need to add anything that says accumulated depreciation as a positive. And oftentimes it's a lot easier to see how this is working with one account because oftentimes you're going to see, 15, 20, 100 different items here. So you can't, it's harder to understand. But now we're doing all these with this, like a single item so you can really see the logic. So here I should be able to just sum that up, drag it over, add the previous period, and voila. So that zeroes out, so that's good. Um, what else do we need to do on this entry? So we zeroed out that. Um, we have depreciation expense, all that's coded. The sale of capital assets. So here's where it gets tricky. Let's see how we're defining. So gain on sale is, what are we saying? The book value is 15,000, which is 50 minus 35. So we have the initial purchase amount less the total depreciated amount. Okay, does that make sense? So book value is 15,000. And then if we sell it for 20, okay, so this is going to be another entry that you have to manually do, but it makes sense. So if we look at this here, we're selling it for 25. The book value on the sale month is going to be, let's see, 26. What's our total depreciated amount? 29. So you'd have to do some math here, but you could say total capital asset purchase is 250 minus accumulated depreciation 220. So this is book value less, and we'd take a loss here. So let's actually increase this just to say, let's say this is 250 or 40. I'll say 225. So in theory here, your profit is this amount. So you're gonna have to manually you'll have to do that calculation, put it in here, and you'll put, let's see, what do we need to put on here? Yeah, gain on sales and manual entry, and we don't have that in here. So you have to actually also define gain on sale. Now gain on sale, we now can select that. So there's our gain. It definitely does have to match your total initial purchase less depreciation. That's the value. You compare that to the sales price, and it's going to be a gain or a loss. So this amount will hit other income. So let's go to other income. And so that's okay. We'll just add 2. So anything that says other income plus anything that says gain on sale, so you can kind of separate that out, is going to hit there. And that is taxable. Okay, so there's that. Now, oh, we got to put a date in here. So there's our sale. Let's see what else we have. So balance sheet here. Oh, we also have to put, so this would be on investing activities as well. We need to put the proceeds from gain on sale here. And let's just sum anything up that says sale of capital assets. And you'll see how this balances out with the gain and the cumulative depreciation and all that. Let's see, put this here. Sale of capital assets. All right, so there's that amount. So we have the gain. We have the total sale here, but we don't want to double count that. We have depreciation expense. Holy cow, my monitor is, I don't know why. This is the first time this has happened. Every 3 seconds it's going blank for like a second. And I can't, it's making this very difficult. It's like torture, literal torture. I'm about to fix my cords after this stream's over. Okay, so we're out here. Let's see, what are we missing? So we have to reduce the fixed asset as well. So we have to remove this 250,000 from here. So property, plant, and equipment is going to be this, and then we're going to have to also put in minus anything. Oh, this is really annoying. It's just blank. I have a blank screen. I can't see anything. Okay, there we go. Oh, come on, computer. What are you doing? Oh, now I'm lost. What did I just change? I don't even know what I just changed. Well, let me undo this. Oh, shoot. Okay, I think capital asset purchase on account. Okay, and then we want to also, so we want to decrease this by sale of capital assets. Okay, and add the previous period. Now, why is this saying, why is this 25,000? What do we do here? Oh, shoot. Shoot. So how do we handle this? Because when we sell it, we need to reduce, this full amount. But I'm selling it for some difference. Like you're not gonna sell it just for the same amount. Here's what I think you have to do, and I'll put this in the notes. When you put sale of capital assets, you have to put the actual amount. the full amount that it was worth. Whatever it was before depreciation. So that will zero this out, which makes sense. We zero out accumulated depreciation for that item. Okay. We have cash flow statement. We didn't get the full 250. This is where things get really tricky. And I get what the entry needs to say, but I'm trying to think about how to code it in here so it makes sense. So here's our depreciation hitting. Why is this positive? Because of the gain against this number. And then adding back depreciation amortization here. Okay. So 254. Now, obviously we know, shoot, this is going to be tough. This is going to be tough. Right now, our variance here is the amount of difference between it's the difference in this gain of sale and I think the accumulated depreciation. Let me see. Yeah, 25,000. We might have to continue this tomorrow because I mean this is going to be pretty intense and I'm going to have to think about a clever way to do this. We might have to restructure some things as well. It definitely needs to be in here to be useful, for sure. But somehow we need to zero out the initial amount, but we want to say how much we actually got for it in total. Like, let's say it was again 225. This amount shouldn't be here. This should be 0. Unless we have to do 2 entries maybe. So if you sell a capital asset, you have to put sale of capital asset, put the amount, and that only goes towards the balance sheet. And then you also have proceeds from capital asset, and that's what's measured against that's how you figure out the gain on the sale, and that's what flows to the cash flow statement. So let's put this in here in November. We want to add an entry here, proceeds from sale of capital asset. Right, so that's going to be a little trickier because you have sale of capital assets to reduce it, but you have the actual amount here as a separate item. And so this is going to be proceeds, and let's say we actually only got, again, what was our profit? So this, sum of all of this. All right, we have it there. We want to subtract out 250 from here. So the book value is 220, and we're selling it for, let's say, 228,000. So that's the actual, so the profit here, let's update the profit to this amount. Now this might work. Just had to do an extra entry, but let's make sure. So other income is this gain. We have depreciation happening. Let's go to the balance sheet. We reduce this down. We also reduce this down. Retained earnings is going up a little bit because we had a gain. Now the cash flow statement actually should be not sale, but proceeds. Proceeds from sale of capital assets. And actually, what did I call it? Proceeds from sale of capital asset. Okay. Now that's less. That's the actual cash we got. That's there. Shoot, we're still out by the profit amount. Let's see. So retained earnings is going up. Cash is going up by how much? 235. What is cash is going up by 235, which is this and this. That needs to be 228 though. We're getting a total of 228,000. And we don't want to double count. Oh, it's complicated. So this is our total. This is the gain. We're out by that gain because we're essentially double counting the gain. Let's go back to this entry here. So if I could see, my screen's literally just blanking black. Cash. So this is the amount we sold the fixed asset for. Reducing and accumulated depreciation. Reducing the full amount of the fixed asset. So that's the new entry we did here. This is the actual amount we sold it for. And then gain. So this hits income statement, reduce asset, reduce a contra asset. So that's the difference. So 35, 45, 55. Asset disposable. Yeah, we'll have to do some of these other things too. All right. Let's think about this. So what are we? Let's just follow our logic with this. So depreciation expense we did. Cash is going up by the sale amount. We have cash going up by the sale amount. However, we have net income as in our cash flow statement, which is hitting other income as a gain. So do we need to reduce that gain out of here? I guess that's the question. This is just crediting the gain. Oh, man. We are reducing to 250,000, so 250,000 down on an asset. We're also reducing the accumulated depreciation, so that's going up. We're going up on the asset by the total accumulated depreciation. So in theory, the assets are going net up by the difference between this and this. Or no, they're going down. They're going down by 250, up by whatever the total amount is here. So okay, net of 14,238. We then have retained earnings, which is going up by, now here's interesting. So why is this only going up by 4,000 when our gain, because we have depreciation happening in this period as well. So we have a gain, but we also have this expense. So 4,785 is what this is going up by, which is correct. Okay. Let's make sure we're adding all these other things in. Now we're still out, so this is the gain we're out by. And it clearly we're adding the gain here, but we're also adding it here. Like this 228, the gain that's happening from that is in this number as well. So we're double counting. Now the question is, how do you properly show? Let's look at gain on capital asset cash flow statement. Let's see what they're doing here. Where does capital gain go on cash flow statement? Long-term. Okay. Can we get definitely? Okay. When a company sells one of its long-term assets and the amount of the proceeds is greater than the book value, the difference is a gain on the sale or disposal. If the amount received is less than the book value, is a loss. To have the book value at the time of the sale, the asset's depreciation must be recorded up to the date of the sale. Fine. Assuming the company sells one of its company cars for $10,000 after recording the depreciation to date of the sale, the book value is $6,000, cost $28,000 minus company depreciation $22,000. The company will have proceeds of $10,000 and a gain on the sale of $4,000. On the statement of cash flows, okay, here we go. On the statement of cash flows, the proceeds from the sale of a long-term asset is reported as a positive amount in the investing activities section. Okay, so that's this proceeds right here, investing activities. The total proceeds 228, which is this amount. Since the gain on the sale is included in net income, the gain is shown as a deduction. The gain is shown as a deduction from net income, reported in the operating activities section. Ah, okay. We have confirmation. That's good. That's great. That's great. So we put in here in the operating activities, because we already have it in the income, reduce gains on sale of capital assets. Perfect. And do we know what that gain is? We do. So it's a negative number, and it's just going to reference this right here, because you actually have to calculate the gain on sale based on the book value and then what you sell it for. So here the book value is 220, we're selling it for 228. There's the gain. That gain is already counted in this proceed, so and it's in net income. So just like we just saw from the reference there, this has to be reduced out, which makes complete sense. Gain on sale. That's what I thought needed to happen, but I needed a confirmation that that is the correct thing to happen. And then now we're zeroed out, and that makes sense. So this zeroes itself out on the cash flow. This is the actual cash that's happening. We go to the balance sheet, and now we're balanced. And so awesome. That was harder than I wanted it to be, but hey, we added it, so that's another great thing to have. So we have our, if we look at this thing from start to finish, we buy a piece of equipment for 250, cash goes down, equipment goes up, we start depreciating it, accumulated depreciation goes up, it would affect our net retained earnings in a negative way. So that's the total depreciation there. Now we sell the asset in November. Cash goes from 250 to 222 based on the net selling price. We also have the total value of the asset of 250 is going to zero. Accumulated depreciation for that asset's going away. So the net total assets left here is essentially, let's see, what's this negative 22? That's, oh, it's saying that's the net cash effect of the whole thing is negative 22, which is fine. That's also what the retained earnings number is showing, so we're matched up there. Cash flow statement. Here was the payment. Here was the proceeds. This is zeroed out. We have our depreciation expense. And note that, so that 22,000 is going to be the difference, I believe, between these two. Yeah, because what that's saying is we essentially paid 250 and then sold it for 228. So net on net, the cash went down by 22,000 in that period. All this other stuff is non-cash items. Depreciation expense, the capital asset purchase. This, the only cash items are this 250 and this 228. Note, and I'll put a note when I do this, is the sale of capital assets is going to be a non-cash item. It's just to zero out the, essentially to credit the asset amount. So I'll put notes on every single, when I'm done with this, I'll put notes on every single one of these accounts so you know what you're doing, if you're trying to do this. So you have to record two different things on the sale, the actual proceeds and then the actual sale of the capital asset of, we need to remove that from the balance sheet with this amount. And this is the actual money we got. So really, we bought it here, we sold it here. Everything else is non-cash depreciation, accumulated depreciation, gain or loss on sale. Those are all non-cash items that happen. The only actual thing that affects cash is the 250 and the 228, which you can see right here. These are all zeroed out. Balance sheet looks good. So this is awesome. This is all proper. Huge day today. Huge day. So what we got done, like you just saw, the sale of the capital assets. We also did dividends, declare dividend, pay dividend. We did other income, other expense. We did loan proceeds, principal payment, interest expense, payment for interest, and income tax as well. So all of this was done today. Oh, and we did deferred revenue. Deferred revenue, recognized revenue. So huge day, very productive. This sheet's getting better and better. Tomorrow, let's see, what else do we need to account for? So we did the disposal, we did dividends. Um, what is the other major item that should be in here? This is all figured out. Oh, common stock. So yeah, equity investments, we'll have to do that tomorrow. And then that's going to be like, I mean, we're going to be really getting far on this thing. Uh, I'm going to put a note just so I don't forget as well on this. So on sale of capital assets, this is a non-cash effect. It is to provide a way to reduce capital assets that are sold. The proceeds entry is to record the value received at sale disposal, if any. I'll just put that note there just so I have it. All right, guys. Well, that's all I got for you. If you want to support me, check out smarthelping.com. I've got hundreds of financial models, mostly forecasting tools, 5 and 10-year financial models for all different industries. I've also got some accounting tools, which what we're doing now is going to be added to this bundle to track receivables, inventory stuff, tracking various metrics, cash conversion cycle, cost of goods sold, FIFO, calculations, budgeting, depreciation expense tool. All kinds of stuff here though I've built over the years. So check it out. You can buy everything for $9.99. That includes anything I build in the future as well. You can just ask for a refresh whenever you want, and I'll send it over. Alrighty, take it easy. We'll really get tomorrow. We're gonna get as far as we can, and then maybe start cleaning things up. And I'm excited. I mean, this is a full accounting system. It produces financial statements, and it's really awesome. Really awesome. Alrighty, take it easy. See you guys